You're checking your bank account this morning and something doesn't add up. Your Social Security deposit is smaller than last month. No warning, no letter. Just less money when you need it most. Right now, thousands of American seniors are discovering the same shocking reality, and the IRS isn't making it easy to understand why. If you're retired or planning to retire soon, drop a comment below with your state so we can see how widespread this issue really is. And hit that subscribe button because what I'm about to reveal could save you thousands of dollars. The term? Clawback sounds like something from a crime thriller, but it's become terrifyingly real for retirees across America. This isn't about traditional taxation that you see coming. This is about the IRS reaching back into benefits you've already received. It's benefits you counted on and reclaiming money through a complex web of tax provisions that most people never knew existed. The mechanics are buried in tax code sections that would take a lawyer weeks to decipher. But the impact hits your wallet immediately. Let's talk about what's actually happening in plain English. When you file your taxes as a retiree, the IRS calculates your combined income using a formula that adds your adjusted gross income, your non-taxable interest, and half of your Social Security benefits. If that combined total exceeds certain thresholds, suddenly up to 85% of your Social Security becomes taxable income. For a single filer, that threshold is just $34,000. For married couples filing jointly, it's $44,000. These numbers haven't changed since 1993, which means inflation has pushed millions more seniors into this tax trap without Congress ever voting to expand it. Here's where the clawback element becomes crystal clear. Many retirees don't realize they've crossed these thresholds until tax season arrives. Maybe you took a part-time job to make ends meet. Perhaps you withdrew money from your IRA to cover medical expenses. You might have even sold some stocks to pay for home repairs. Each of these actions increases your combined income, and suddenly the IRS is taxing Social Security benefits that were deposited into your account months ago. You've already spent that money on rent, groceries, and prescriptions, but now you owe the government a portion back. The situation gets worse when we examine the withholding problem. Unlike regular paychecks, where taxes are automatically withheld, Social Security allows you to voluntarily have taxes taken out. But many seniors don't elect this option because they don't realize they'll owe taxes later. The Social Security Administration offers withholding rates of 7, 10, 12, or 22%. But choosing the right percentage requires predicting your entire year's income, which is nearly impossible when you're dealing with variable sources like investment returns or freelance work. Recent data from the Social Security Administration shows that approximately 56% of Social Security recipient families now pay federal income taxes on their benefits. That's up from around 10% when the taxation of Social Security benefits first began in 1984. The demographic shift is staggering, and it's happening because those income thresholds remain frozen in time while the cost of living continues its relentless climb. A senior who is safely below the threshold 5 years ago might now be thousands of dollars over it without earning a single extra penny, simply because their cost of living adjustments push them into the danger zone. The provisional income calculation creates particularly cruel scenarios for widows and widowers. When a spouse passes away, the surviving partner loses one Social Security check but often retains the same living expenses. They switch from married, filing jointly to single filer status, which cuts their threshold from $44,000 to $34,000. Meanwhile, they might receive a one-time life insurance payout or inherit retirement accounts that must be liquidated, spiking their income for that year. The result is a massive tax bill precisely when they're most vulnerable emotionally and financially. State taxation adds another layer of complexity that varies dramatically depending on where you live. Currently, 9 states tax Social Security benefits to some degree: Colorado, Connecticut, Kansas, Minnesota, Missouri, Montana, Nebraska, New Mexico, and Rhode Island. Each state has its own rules, exemptions, and thresholds. Missouri, for example, began phasing out its Social Security tax in 2024. But the process is gradual and depends on income levels. Colorado offers deductions for taxpayers over 65, but younger retirees and disabled recipients get hit with the full state tax burden on top of federal obligations. The penalty structure for underpayment makes this situation even more punishing. You don't pay enough tax throughout the year, either through withholding or quarterly estimated payments. The IRS charges underpayment penalties and interest. The current interest rate for underpayments is 8% annually, compounded daily. For a retiree who discovers at tax time that they owe $5,000 in taxes on their Social Security benefits, that could mean hundreds of dollars in additional penalties that accumulate while they're scrambling to figure out payment arrangements. Let's examine some real-world scenarios that are playing out right now. Take a retired teacher in Ohio who receives $2,200 monthly in Social Security and has a small pension of $1,000 per month. She stays below the taxation threshold comfortably until her roof needs replacement. She withdraws $15,000 from her traditional IRA to cover the cost. That single withdrawal pushes her combined income high enough that 85% of her Social Security becomes taxable. She ends up owing approximately $3,400 in federal taxes, money she no longer has because it went to the roofing company 6 months ago. Or consider the Florida couple who retired early at 62 and claimed reduced Social Security benefits. They supplement their income with part-time work, each earning about $18,000 annually. Their combined Social Security is $36,000 per year. Paper. Their total income is $72,000, which sounds comfortable. But after calculating their combined income for tax purposes and applying the taxation formulas, they discover that $30,600 of their Social Security is taxable. Add in their work income, and they're paying federal taxes on $66,600, pushing them into the 22% tax bracket. They assumed Social Security would be tax-free, so they didn't withhold anything. And now they face a $6,800 tax bill with penalties. The pharmaceutical industry's pricing practices intersect with this problem in ways that deserve scrutiny. Seniors who fall into the Medicare Part D coverage gap, commonly known as the donut hole, often withdraw extra money from retirement accounts to cover prescription costs. Those withdrawals increase their combined income, triggering Social Security taxation. They're essentially being taxed on money they're spending because drug prices are inflated. It's a vicious cycle where healthcare costs create tax liabilities that reduce the funds available for future healthcare. The situation with required minimum distributions compounds these issues for seniors over 73. The IRS mandates that you begin withdrawing specific percentages from traditional IRAs and 401k plans, whether you need the money or not. These forced distributions count as income and can easily push you over the Social Security taxation thresholds. For someone with a substantial retirement account, the RMDs alone might trigger taxation on 85% of their Social Security. It's creating a tax bill on money they didn't want to withdraw in the first place. Now we need to address the strategies that financial advisors are quietly sharing with their clients while millions of other seniors remain in the dark. Roth conversions, when executed properly years before you claim Social Security, can dramatically reduce future tax exposure. By converting traditional IRA funds to Roth accounts and paying the taxes upfront during lower income years, you eliminate future RMDs and create tax-free income that doesn't count toward your combined income calculation. But this strategy requires planning that most people don't receive until it's too late. Timing. Social Security claims strategically can also minimize taxation. Delaying benefits until age 70 increases your monthly payment by 8% for each year you wait past full retirement age. If you can live on other income sources in your 60s, Those larger payments later might keep you below thresholds even with other income sources. Conversely, claiming early and using those benefits to avoid IRA withdrawals might make sense in specific situations. The calculations are complex and personal, requiring analysis of life expectancy, other income sources, and tax bracket projections. Tax loss harvesting in investment. Counts offers another tool that sophisticated retirees use to manage their combined income. By strategically selling investments at losses to offset gains, you can keep your adjusted gross income lower, which directly impacts whether your Social Security gets taxed. This requires maintaining taxable investment accounts rather than holding everything in retirement accounts, and it demands attention to IRS wash sale rules that prohibit buying substantially identical securities within 30 days. The qualified charitable distribution strategy provides a powerful option for charitably inclined seniors over 70 and a half. You can direct up to $105,000 annually from your IRA directly to qualified charities. This money counts toward your RMD but doesn't appear as income on your tax return, which means it doesn't increase your combined income for Social Security taxation purposes. You're fulfilling your charitable intentions while simultaneously protecting your Social Security from taxation. Geographic arbitrage through relocation represents perhaps the most dramatic strategy available. Moving from a state that taxes Social Security to one that doesn't can save thousands annually. Beyond just Social Security taxation, states differ enormously in how they treat pension income, retirement account withdrawals, and property taxes. A retired couple in Connecticut paying state taxes on their Social Security plus high property taxes might cut their tax burden by 40% or more by relocating to Florida or Texas, both of which have no state income tax whatsoever. The political landscape surrounding Social Security taxation reveals troubling realities about how these policies emerged and why they persist. When Congress first made Social Security benefits partially taxable in 1984, it affected only the highest-earning retirees. The idea was that wealthy seniors should pay taxes on benefits exceeding what they contributed. But inflation has transformed that targeted policy into a middle-class burden. Despite proposals from both parties to eliminate or reduce Social Security taxation, the revenue generated currently about $50 billion annually makes it politically difficult to eliminate. Recent legislative attempts to address this issue have stalled repeatedly. The Senior Citizens Tax Elimination Act has been introduced multiple times with bipartisan support but never reaches a vote. The You Earned It, You Keep It Act, which would eliminate Social Security benefit taxation entirely, remains in committee. The Social Security 2100 Act includes provisions to adjust the income thresholds for inflation. But comprehensive Social Security reform faces political gridlock. Seniors are caught in the middle, paying increasing taxes while Congress debates solutions that never materialize. Looking at the numbers from the most recent tax year reveals the scope of this issue. The IRS collected approximately $47.5 billion in taxes on Social Security benefits. That money came from retirees' pockets, many of whom were unprepared for the tax liability. The average amount of Social Security benefits subject to tax was roughly $17,500 per recipient, translating to additional tax burdens of $2,000 to $4,000 depending on tax brackets. For seniors living on fixed incomes where every dollar matters, these unexpected tax bills create genuine financial crises. The enforcement mechanisms that the IRS employs to collect these taxes deserve examination. If you can't pay your tax bill, the IRS can place liens on your property, levy your bank accounts, and garnish up to 15% of your Social Security benefits. Yes, the same benefits they taxed can be garnished to collect the taxes owed on those benefits. The irony is cruel but legal. The IRS offers payment plans, but these come with setup fees and ongoing interest charges that can add hundreds or thousands to what you ultimately pay as we move deeper to 2025. Several factors are converging to make this situation more acute. Interest rates on savings remain relatively high, which means seniors with savings accounts are earning more taxable interest than they did a few years ago. Stock market volatility encourages retirees to lock in gains, but those capital gains count as income. Healthcare costs continue rising faster than general inflation, forcing more IRA withdrawals. Each of these trends independently pushes more seniors over the taxation thresholds, and together they create a perfect storm of unexpected tax liability. The information gap remains. It's perhaps the biggest problem of all. Financial literacy among seniors varies enormously, and the complexity of tax law makes it nearly impossible for average retirees to navigate these issues without professional help. Yet quality financial advice costs money that many seniors don't have. The IRS provides publications explaining the rules, but these documents are dense with jargon and cross-references that require accounting knowledge to interpret. Community organizations and senior centers offer some assistance, but they're often overwhelmed and underfunded. If you're watching this and wondering what you should do right now, today, here's the action plan. First, calculate your combined income using last year's tax return. Add your adjusted gross income, your non-taxable interest, and half your Social Security benefits. Compare that total to the thresholds. If you're close or over, you need to act. Second, contact Social Security immediately and set up voluntary withholding if you haven't already. Start with 10% and adjust based on your actual tax liability. Third, meet with a tax professional before making any major financial moves like IRA withdrawals or asset sales. The consultation fee is tiny compared to the taxes you might avoid. This crisis isn't going away without legislative action. And legislative action requires public pressure. Contact your congressional representatives and demand that Social Security. Taxation thresholds be adjusted for inflation or eliminated entirely. These aren't partisan issues, they affect retirees regardless of political affiliation. Your voice matters, but only if you use it. The power to change this system exists, but it requires collective action from millions of affected seniors who refuse to accept being quietly taxed into poverty. The Social Security tax. Clawback represents a fundamental breach of trust between the government and citizens who worked their entire lives expecting a secure retirement. Understanding the mechanics, recognizing your vulnerability, and implementing protective strategies can mean the difference between financial security and crisis in your retirement years.